Hello everyone, welcome back to Advanced Accounting. In last class, we talked about how to do consolidation subsequent to the date of acquisition. And in today's class, we are going to talk about how to do consolidation if the parent has less than 100% ownership of the subsidiary. But before we get started, let's do a brief review. So subsequent to the date of acquisition, if both firms survive, the parent can choose either one of the three methods. Those three methods are the equity method, the initial value method, and the partial equity method. And depending on which method the parent choose, so it can be either one of the three methods, and depending on whether it is in the year of acquisition or subsequent to the year of acquisition, the consolidation process differs a little bit. They are in general very similar, but they also differs in some very subtle specific ways. Specifically, if the parent chooses to use the equity method, and if it is in the year of acquisition, but it is subsequent to the date of acquisition, but it is still in the year of acquisition, the consolidation entries the parent needs to make in the consolidation process are consolidation entries S, A, I, D, and E. Those are the 5 basic consolidation entries. However, if the parent is using the initial value method, the entries are S, A, I, and E. D is kind of already taken care of by consolidation entry I, so we don't need to do consolidation entry D here. And if the parent is using partial equity method, the consolidation entries again are S, A, I, D, E. And here, the consolidation itself are very similar to when the parent is using the equity method, but the numbers will differ a little bit. And if it is subsequent to the year of acquisition, so here it is, for example, the acquisition happened in the year 2016, and if we are now moving to 2017, so that is subsequent to the year of acquisition. If the parent has been using the initial value or the partial equity method, we need another consolidation entry star C, to adjust the parent's beginning retained earning to what it should be under the equity method. So as part of the review, let's now look at an example. So if you go on Island, you should be able to see a blank page of this review program. Just first take 10 minutes, try to work on it on your own. And then you can pause your video for now. And then after you have tried yourself, you can come back to listen to my explanation of this problem. Okay, so let's now look at this problem. Fox Corporation acquired all of Greenberg Company's outstanding stock on January 1st, 2016. For 600,000 in cash. So the consideration transferred here is 600,000 in cash. Greenberg's accounting record shows net asset on that date of 470,000. So book value, so net book value of the firm is 470,000. So, and in other words, there's an excess payment here. Fox Corporation is paying 600,000 for something which only has a book value of 470,000. The difference, the excess payment is 130,000. And then we need to figure out where this 130,000 is coming from. So the explanation here is equipment with 10 years remaining life was undervalued on record by 19,000. So now we know that part of this 130,000 difference is coming from, part of it is coming from equipment, which is undervalued on the book for 19,000. Any unrecognized goodwill is considered to be indefinite life. So, and it seems like besides this equipment, there's no more asset which has a difference between book and fair value. And then we still have 40,000 difference excess payments that is not explained. And this 40,000 is counted as, it is classified as goodwill. So goodwill is 40,000. And then for this 90,000, the difference between fair and book value for the equipment, it has 10 years remaining useful life. So meaning that this 90,000 can be amortized over 10 years, and each year the amortization is 9,000 per year. And goodwill is not amortized. It has indefinite useful life, so we cannot amortize it. It is not amortized. Greenberg reports net income in 2016 of 90,000, in 2017 of 100,000. The subsidiary declares dividend of 20,000 in each of the 2 years. So the acquisition happened at the beginning of 2016, and then 2016, 2017. The net income for 2016 is 90,000. For 2017 is 100,000. Dividend for 2016 is 20,000. For 2017 is 20,000 again. Accounting balance for the year ending in December 31st, 2018. So that is 1 year later after that, as shown on the next page. And then, so there are several questions here. The first question is, please determine the consolidated balance for the following accounts at the end of 2018. So we're going to come back to look at this question later, but let's move to the next one. How does the parent's choice of accounting method for its investment affect the balance computed in requirement A? So in other words, this is asking what parent's choice of accounting method, what can those accounting methods be? So the parent can choose among 3 of the methods, right? Either the equity method, initial value method, or partial equity method. So this question is asking what the parent's choice of accounting method. Does parent choose equity method versus initial value method versus partial equity method? Would it affect the balance computed in requirement A, or in other words, would it affect the consolidated total account balances for the firm? And for this one, we already spent a lot of time talking about it in last class. So the answer is no. No matter which methods the parent choose, their consolidated total numbers would all be the same. And then the question say, which method of accounting for this subsidiary is the parent actually using for internal reporting purpose? So now let's look at the parent book here. At the end of 2018, which method do you think the firm is using, the parent is using? Right, so the parent is using the initial value method. Why? So there are actually 2 places that tells us the parent is using the initial value method. First of all, let's look at its investment income. Here, investment income is recorded as 20,000. What is this 20,000? That is the dividend. That is the dividend paid out by the subsidiary in each of the year, right? So when would we record dividend as income? That is only when the parent is using the initial value method. So this is one place you can figure out that the parent is using the equity method. And there's another place you can figure out the parent is using the equity method. It is from the firm's investment account. So the investment account balance is 600,000. Why is it 600,000? What is this 600,000? That is the initial investment here, right? So it is only under the initial value method do we record the investment account balance is always the initial investment. It is not affected by dividend. It is not affected by the income by the subsidiary. It is not affected by amortization. It is always the initial investment, which is 600,000. So those are the 2 places that tell us that the parent is using the initial value method. And then question D. If the parent company had used a different method of accounting for this investment, how would the method have, how could that method have been identified? So what if the parent is using the, for example, the partial equity method? If the parent has been using the partial equity method, what would be the amount for its investment account? So please take 5 minutes, think about it. How would the parent's accounts differ if the parent has been using the partial equity method or the equity method? Sorry, here. So actually, there's some omitted information here. So, Greenberg reported net income in 2016 of 90,000 and 100,000 in 2017. And I want to add another information here that it is 100,000 again in 2018. And then the subsidiary declares dividend in each of the following 3 years. So it is 2016, 2017, and 2018. Sorry about that. So if the parent firm has been using the partial equity method, first of all, the investment income. Instead of recognizing the subsidiary's dividend as its income, now the parent is recognizing the subsidiary's income as its income. So the investment income should be 100,000. Right. And then if the parent has been using the equity method, the investment income should be 100,000. And then we need to take out amortization, 9,000. So investment income should be 91,000. So this is regarding the investment income. And how about the investment account? The investment account balance will differ as well. So if under the partial equity method, we start from 600,000 initial investment. And then under the partial equity method, we need to add all of the subsequent subsidiaries income, which are 90,000, 100,000, and 100,000. And then we need to take out all of the subsequent subsidiaries dividend. So we need to take out 20,000, 20,000, and 20,000. And that is if the parent has been using the partial equity method. And then if the parent has been using the equity method, so based on the investment account, based on the partial equity method, we need to further take out 3 years amortization. So those are, I'm not writing here, but those will be the differences. And then the last question is, question E is, what will Fox balance for retained earning as of January 1st be if each of the following method has been in use: initial value, partial equity, and equity method. So we already know here the number retained earning 1.1 million, that is under the initial value method. Then how about under the partial equity method and under the equity method? Under the partial equity method, the difference between initial value and the partial equity method is we start from 1.1 million, which is retained earning under the initial value method. And then under the partial equity method, we no longer, under the partial equity method, we don't recognize dividend as income. So all of the previous dividend, which goes into the retained earning under the initial value method, we need to take them out. So we need to take out 20,000 dividend recognized in 2017, and then take out 20,000 dividend recognized in 2016 under the initial value method as income. And then we need to add back 90,000 and 100,000 for the 2016-2017 income, which should be recognized as income under the partial equity method. And this will give you the retained earning under the partial equity method for 1.25 million. And then for the equity method, if the firm has been using the equity method, based on the partial equity method, the only difference is we need to take out 2 years amortization. So that will give you 1.232 million. So after finished all of these questions, let's go back to calculate the account balances. So we have already identified here the parent firm has been using the initial value method. And under the initial value method, subsequent to the year of acquisition, the first consolidation entry we need to do is consolidation star C. The purpose is to convert this 1.1 million beginning retained earning recognized under the initial value method into what it should be under the equity method. So we actually already calculated this number under the initial value method. The beginning retained earning is 1.1 million. And then under the equity method, the beginning retained earning should be 1.232 million. So we need to add another 132,000 to it in order to increase the retained earning amount. Retained earning has a balance on the credit side. In order to increase it, so we need to credit retained earning of 132,000. And then we need to increase our investment account accordingly. So this is consolidation entry star C. Consolidation entry S, the purpose is to eliminate subsidiaries beginning stockholders equity account. Subsidiary has beginning common stock 300,000. To eliminate it, we debit 300,000 common stock. Subsidiaries beginning retained earning is 320,000. To eliminate it, we debit 320,000 retained earning. And this 320 plus 300,000, that is 620,000. To make it balance, we credit investment account for 620,000. So this is consolidation entry S. Consolidation entry A, the purpose is to mark up subsidiaries, all of its assets and liabilities from its book value to fair value. And we know that subsidiary has equipment with difference in book and fair value of 90,000. So the original difference is 90,000. And then this difference has been amortized for 2 years, year 2016 and year 2017. So we need to take out 2 years amortization here. And then so the resulting difference, the difference we still have at the beginning of 2018, that is only 72,000. So we mark up equipment for 72,000. And then we also know there's a difference there's a goodwill that some of the excess payment goes into goodwill. So we need to recognize goodwill as well. Goodwill is 40,000 and it is not amortized. So 72 plus 40, that is 112. And then we decrease investment account by 112,000 accordingly. So this is consolidation entry A. Consolidation entry I, the purpose is to eliminate all of the income recognized by the parent, which is from the subsidiary. And then because here the firm is using the initial value method, so the purpose we also need to we need to take care of the inter-entity dividend payment here. So we debit investment income by 20,000 and to credit dividend declared by 20,000. And consolidation entry D, we don't have D in this situation because the firm is using the initial value method. D has already been taken care of here by consolidation entry I. The last one, consolidation entry E. The purpose is to recognize current year amortization of the excess payment. So we credit 9,000 amortization for the equipment. And then this is depreciation because equipment is a tangible asset. So this is depreciation expense for the firm. And then the last step is to calculate the last column consolidated totals. For most of the part for consolidated totals, we add up everything horizontally. But for some specific accounts like net income, we need to add them up vertically, and some of the other accounts like a retained earning, we need to carry it over. So let's do it together. All of the accounts here up until investment income, everything we need to add them up horizontally. So consolidated revenue is 1.4 million. Cost of goods sold is 250,000. Depreciation expense is 659,000. And investment income should go to 0. And then that income, we add up everything vertically. So that adds up to 491,000. And this 491,000 is carried over to a statement of return earning. So 400, sorry, it's carried over to here, 491,000. And then retained earning, the beginning retained earning, if you add everything up, that is 1.232 million. Dividend, so the dividend paid by the subsidiary to the parents, that is inter-entity payment. The only from the outside shareholders' perspective, everything they care about is dividend paid out to the outside shareholder, which is, so this two cancel out. So for the outside stockholders, the actual dividend is only 120,000. And then retained earning ending balance, you add up everything vertically. So that will give us 1.603 million. And this 1.603 million is carried over to a balance sheet. On your balance sheet, current assets, the total is 400,000. Your investment account should go to 0. So those should cancel out. Equipment adds up to 1.563 million. Buildings is 1.2 million. Land is 700,000. Goodwill is 40,000. And then if you add everything up, your total asset would be 3.903 million. And then liabilities will add up to 1.4 million. Common stock adds up to 900,000. And then your total liability and shareholders' equity would add up to 3.903 million as well. So the last check is your total assets should be equal to your total liability and shareholders' equity. So if those two numbers are not the same, there's something wrong. You need to check back at your calculations. So this is a review of what we learned in last class.